In this video, I will analyze a simple market scenario in the daily chart of gold against the US dollar. Gold is a nice chart to work with because it shows a Brownian characteristic due to its high liquidity, very much like what happens in the currencies, meaning that we tend to have smoother price action. From number 1 to number 3, we have the formation of a major solid low in the chart. In other words, number 2 is now a place where we can expect buyers to appear again in the chart if everything else remains constant. Whenever we deal with solid market extremes, we can derive the inward and outward frequencies that always go along with them. In this case, I have the inward frequency marked as trending markets tend to pick themselves up or down in a progressive manner, meaning that in uptrends we have higher lows and in downtrends we have lower highs. The market vectors between number 1 and number 3 are textbook representation of the uptrend pattern of higher highs and higher lows. Buyers cannot make the market rise forever in the same way that sellers cannot make the market fall forever. That idea implies that there is an equilibrium of forces between the two types of market players, meaning that while one accumulates energy, the other will spend it. At high number 3, buyers exhausted their energy to the upside while sellers accumulated it. From number 3 onwards, sellers started to exhaust this accumulated energy and buyers started to accumulate it again. This is the endless seesaw between buyers and sellers in the market. We want to trade in the moments where the seesaw stops going down and starts going up, or vice versa. A good tool we have to measure this dynamic between buyers and sellers is the Andrews pitchfork. The pitchfork will capture the particular geometry of recent market extremes, and it will project a future point of exhaustion. For example, if we draw a standard pitchfork using number 1, 2, and 3 as the axis of the pitchfork, we will see that number 4 is a point of exhaustion highlighted by the geometry of the previous 3 market extremes. Obviously, it isn't always this easy. The simple and predictable way in which pitchforks work tend to function a lot better in running flows with gentle angles in relation to the x-axis of the chart. When the market is too steep, the pitchfork tends to get a little distorted. Observe that in number 4 we have a point of exhaustion of sellers, but we are not deep enough into the demand zone of number 2. That means buyers may be too eager to bring this market up. Notice that the pitchfork and the demand zone are giving us slightly conflicting signals in the analysis. From number 4 to number 5, we have buyers attempting to bring the market up to break the next target, which is the high number 3. If they are capable of breaking that level, they will consolidate the notion that we are in an uptrend. However, we can clearly see that the attempt to break high number 3 is frustrated because price reaches that level and then it starts to fall down immediately. This is where the analysis begins to get complicated because we need to start making judgments about the power of buyers and sellers. The major problem here is that we don't know for sure if number 4 is a mere exhaustion of buyers or the result from price getting near the demand zone from number 2. That's a problem because we can only speculate about which group of buyers are responsible for the price vector between 4 and 5. We can draw another pitchfork using numbers 2, 3, and 4 to project the exhaustion. What we'll see is what's called the Hagopian's rule, which is when price fails to reach a line of the pitchfork. The inability to break high number 3 and the Hagopian's rule are two clear advantages for the sellers of the market. However, we don't have any other piece of evidence to support a trend to the short side. After number 5, price starts to go down until it finally reaches the moment of truth in number 6. It might not seem like it, but there's a lot going on when price reaches that level. So let's unpack it piece by piece. The first thing that catches the eye is the fact that price is touching the inward frequency line that was drawn in low number 2, which is a place that is certain to create at least a bump to the upside. Beyond touching that line, price is creating a hybrid bar, which is something you will find very common in reversal points of the market. Another not so obvious detail is that if we tune the frequency of the first fork that was drawn using numbers 1, 2, and 3 to the overshoot in number 5, we will see that number 6 falls more or less at the center line of this fork. If we draw a third fork using numbers 3, 4, and 5, we can also see how number 6 is near the center line of the fork. This basically means that the sellers from number 5 are in a theoretical exhaustion point, and the buyers are in the theoretical demand area. And we have further evidence of this because of the hybrid bar formation at the inward frequency line. This is a combination that can make you trigger a long trade opportunity due to the correlation of narrative and technique. You should also realize that the most important thing about all of this is that there is a very nice place to put a small stop loss order below number 2, which is the solid low, and there is headroom for this market to travel at least until the level of number 3 and number 5. However, let's not get too optimistic about one side of the market. Let's try to observe what the other side is doing. Notice that the sellers have just created a solid high in number 5 because number 6 closed lower than number 4. Just like I did in number 2, I marked an inward frequency line at number 5. The two lines are obviously symmetrical. If price reaches that point, it is interesting to notice how it reacts around such lines. Let's see what happens next. As we can see, the exhaustion of sellers in combination with the demand of buyers made the market go higher and reach the problematic situation of number 5. Notice, however, that price completely disrespects the line and the minor flow is clearly creating an uptrend. We reach a scenario called flow shift, which is basically the market equivalent of a sleight of hand. Everybody is focused on one side while the other is generating the true opportunity. The moment price comes back to the minor demand zone of the upward flow, we have what's called a Nash equilibrium. A Nash equilibrium, in rough terms, means a situation that maximizes the outcomes of all players of a game simultaneously. We can go short after the hybrid bar that pierces high number 5, and we can go long after the hybrid bar that falls into the minor demand zone. There is a high probability that one of the trades will be successful, and since both have at least 1-to-3 risk-reward ratio, the result can be a profit despite the direction that the market takes. So let's see what happens next. As you can see, the Nash equilibrium at the flow shift creates a situation where we can hedge our positions and trade the natural volatility that comes out of it instead of the direction. That's one great advantage of understanding the subtle game theory of trading with charts. If you wish to understand how to analyze charts like this, check out my training courses in the link available in the video description. If you liked the video, help support the channel by clicking the like button, subscribing to the channel, activating the notifications button, sharing the video, and leaving your feedback below in the comments. Thank you very much for watching. Take care.